According to recent data from the Chinese Communist Party's National Bureau of Statistics, have the Chinese people really become rich? Is it true? Yes, some have indeed become rich. But unfortunately, only a small number of people have accumulated wealth. Although the Chinese Communist Party has never dared to disclose data on the gap between the rich and the poor, clues can be found in reports from financial companies, banks, and consulting firms. In 2023, CICC released data showing that China's total wealth is 790 trillion yuan, with total private property amounting to 430 trillion yuan. Of this, 290 trillion yuan belongs to 4.6 million wealthy people, 110 trillion yuan to 99 million middle-class people, and the remaining 30 trillion yuan to 300 million ordinary people. What does this mean? It shows that the 4.6 million wealthy individuals have an average asset of 63 million yuan per person. The 99 million middle-class people hold an average of 1.11 million yuan per person, while the remaining 1.3 billion ordinary people only have an average of 23,000 yuan, about $3,200 per person. It's no exaggeration to call them the proletariat. Essentially, the wealthiest 0.33% of the population owns 67% of the country's wealth, while 92.77% of the population owns only 7%, which is a mere fraction of the rich's holdings. There must be 2,739 poor people, each with an average income of less than 30,000 yuan, to equal one rich person with an average income of 60 million yuan. In addition, China Merchants Bank also provided data for reference. 0.07% of the wealthy hold a total of 3.74 trillion yuan in deposits, accounting for 31% of total bank deposits. Another 2.18% of the population, considered the second-tier wealthy, hold around 6 trillion yuan in deposits, representing 50.3% of the total. Meanwhile, 97.75% of the poor hold just 2.22 trillion yuan in deposits, which is only 18.7% of the total, with an average personal account holding of only 12,500 yuan. These figures reflect the statement made by former Premier Li Keqiang, who noted that 600 million people in the country have a monthly income of less than 2,000 yuan, a number that may even be optimistic. The latest data released by the CCP reveals another secret. Over 70% of people do not need to pay personal income tax. If an individual's annual income is less than 100,000 yuan, they are essentially exempt from paying income tax. In other words, most people have little to no money. This data does not include the super invisible rich who do not declare their wealth, but it does show that the top 1% of earners pay 50% of taxes, while the top 10% pay over 90%. From this, we can conclude that China's wealth gap is far beyond people's imagination, with a very small number of people holding vast wealth. The wealth gap in China has exceeded that of the United States. These figures are astounding, but more frightening is that China's wealth gap has been widening over the years. In 2023, sunflower clients accounted for only 2.4% of China Merchants Bank's customer base, but held 81.2% of the total assets. In 2007, sunflower clients held just 55.1% of assets. Minsheng Bank follows a similar pattern. Based on these calculations, 20 million Chinese elites hold 118.1 trillion yuan in deposits, while the other 1.4 billion people collectively hold only 29.5 trillion yuan, along with 81.6 trillion yuan in loans. This shows that most Chinese people are struggling. Another worrying issue is that after the current round of economic rescue efforts, the wealth gap will likely widen further. Retail investors have pumped around 3 trillion yuan into the stock market, but listed companies are cashing out, and institutions are profiting and moving funds elsewhere. Once the rescue is complete, most retail investors could be wiped out. Xinhua Daily Telegraph published an article on February 24, 2023, titled "Rich and Poor Divide Tears Apart American Society," criticizing the United States for having the richest 1% of households owning over 20% of the country's total wealth, and this proportion continues to rise significantly. However, the article fails to mention that as of the first quarter of 2021, the top 10% of Americans held 69.8% of total net assets. The proportion of American adults living in middle-income households fell from 61% in 1971 to 51% in 2019. China claims to have more than 200 million middle-class citizens. The poverty rate in the United States reached 11.4% in 2020, with 37 million people still living below the poverty line. But if the World Bank's standard of $5.5 per day per person is applied, China has 600 million people living in poverty. This is consistent with what Premier Li Keqiang stated during the National People's Congress in May 2020, when he said there are 600 million people with low to middle incomes, with an average monthly income of around 1,000 yuan, about 140 USD. In 2005, according to the World Bank's standards, there were 150 million people living in extreme poverty in mainland China. After years of significant change under the Chinese Communist Party, the gap between rich and poor has only widened. The People's Bank of China launches financing plan to save the market. Experts call it drinking poison to quench thirst. As China's stock market continues to fluctuate, on Friday, October 18th, the People's Bank of China launched 2 financing plans to inject capital into the stock market. But can this really boost China's stock market? As of August 31st, a total of 5,104 listed companies on the Shanghai and Shenzhen stock exchanges had disclosed their financial statements for the first half of the year, showing operating income and net profit down by 1.4% and 2.4% year-on-year, respectively. The actual situation is reportedly worse. On Friday, the People's Bank of China, together with the Financial Supervision Administration and the China Securities Regulatory Commission, issued a notice stating that 21 financial institutions will be allowed to issue loans to eligible listed companies and major shareholders for the purpose of repurchasing and increasing their holdings of their stocks. The first installment of these re-loans is set at 300 billion yuan, with an annual interest rate of 1.75% and a term of 1 year. On the same day, 6 major banks, including the Industrial and Commercial Bank of China, collectively lowered deposit rates, reducing the interest rate on demand deposits by 5 basis points. Epoch Times columnist Wang He commented, "China's stock market financial reports for the first half of the year show a loss rate exceeding 50%. Given the current situation, the central bank's introduction of this policy won't achieve the desired effect." The notice also stated that financial institutions can independently decide whether to issue loans, reasonably determine loan conditions, and bear their own risks. Analysts believe that the central bank and regulatory agencies are clearly shifting responsibility. Wang He remarked, "In terms of policy design, this is essentially a scapegoating measure, putting all the pressure and burden on commercial banks." On the same day, the central bank, along with the China Securities Regulatory Commission, issued a notice that a new swap facility SFISF operation transaction will be launched for securities, funds, and insurance companies, with a swap period of 1 year and an initial operation quota of 500 billion yuan. Analysts believe that while this policy could bring incremental funds to the stock market, the Chinese economy is already rotten at its core, and loosening the money supply won't truly revive the market. Li Hengqing, an economist at the Washington Information and Strategic Research Institute, noted, "The stock market doesn't generate value. With stock fluctuations, it's essentially a process of asset transfer. So from that perspective, these current measures won't actually solve the problem. It's what we call drinking poison to quench thirst." Since the long National Memorial Day holiday, China's stock market has been turbulent and unstable. A shares collectively dropped on Thursday, with the Shanghai Composite Index falling below 3,200 points as major funds fled. Wang He concluded, "The recent fluctuations in the stock market represent another round of cutting down new leaks. People are increasingly desperate about the Chinese stock market. China's next crisis is about to unfold. The rich have become a dangerous group." After the real estate crash, China's next crisis is ready to unfold. Whether China's current crisis is deflation or inflation, observers have different views. However, they all agree that China's economy is in a depression and becoming increasingly dangerous. Well-known professional investor Bells recently wrote that the real estate crisis is just the beginning. If it is not resolved, it will inevitably escalate into a financial crisis. Bells wrote that China's real estate bubble is the largest asset bubble in human history, once valued as high as 450 trillion yuan. Now that the bubble has burst and prices have collapsed, this is a major historical event that has changed the world. Any decision that ignores this context is dangerous. China's current economic difficulties seem to stem from weak consumption. But why is consumption low and demand sluggish? The reason is that residents have overdrawn their future income for decades and must now repay their debts, leaving no money for consumption. At present, the government shows no sense of crisis and has not taken timely action. Therefore, the crisis continues to worsen, and it will eventually lead to a sharp increase in bad bank debts, evolving into a financial crisis. Bells explained that if residents have no money, the supply side will go bankrupt, and real estate debt defaults will trigger a chain reaction. In the end, everyone will owe the bank. Banks' business models often involve more than 10 times leverage. If banks lose 10% of their assets, when multiplied by 10 times leverage, they would theoretically go bankrupt. In fact, just over 20 years ago, all Chinese banks were technically bankrupt and insolvent. Few remember this period of history, but it seems about to repeat itself. China's economic depression has led to social changes. On September 8th, social media reported that a Meituan delivery rider in Shanghai held a sign on Nanjing East Road, calling for the establishment of a trade union. His sign read, "The times are calling for China's Martin Luther King, and we want our own trade union, our own spokesperson for our interests, and an 8-hour workday." This is what the CCP fears most. Additionally, the economic depression has provided an opportunity for Xi Jinping's political enemies. The CCP is in a state of anxiety. Ming Zhuzheng, an honorary professor of the Department of Political Science at National Taiwan University, analyzed on a live program on the 10th that Xi Jinping began preparing for war after consolidating power. He primarily did 4 things. First, he engaged in a trade war with the United States. Second, he took over Hong Kong, causing foreign capital to flee, leaving Hong Kong no longer able to generate wealth. Third, he imposed lockdowns for 3 years, pushing small and medium-sized enterprises to the brink. And fourth, he promoted the state's advancement while private enterprises retreated, all of which led to China's rapid economic decline. Professor Ming Zhuzheng said that once the economy is depressed, society stagnates, and unemployment follows. When unemployment becomes severe, the crime rate will rise, society will become unstable, and political problems will emerge. The Communist Party has always been ruthless in political struggles. Recently, rumors have spread, all pointing in one direction, hoping for Xi Jinping's downfall. Anti-Xi forces are lurking behind these efforts. Xi Jinping is aware of those opposing him, which has led him to intensify his purges and become more suspicious. Professor Ming said that the CCP has fallen into this vicious cycle of internal struggles, and the only remaining question is who will take the first step. If Xi Jinping wants to save himself, his only option may be to abandon communism. China's housing market crashes, owners strongly dissatisfied. On September 7th, the poor construction quality of Phase 3 of Sunac Airport Chenyuan in Zhengzhou, Henan, sparked strong dissatisfaction among homeowners. During the rights protection process, many homeowners were forcibly taken onto buses by the police, drawing significant public attention. At the same time, the Hangzhou housing market has once again become a focal point, with second-hand homes in many areas experiencing a break-in issue, meaning that the selling prices of second-hand homes are lower than the purchase prices of new ones. Some homeowners even reduced their prices by as much as 1 million yuan in less than a month, causing heated discussions in the market. According to the Changjiang Evening News, this phenomenon is no longer new in Hangzhou. It has occurred in multiple districts such as Taoyuan, Genbei New Town, and Future Science and Technology City. The Taoyuan district is a typical example of Hangzhou's new homes experiencing a break-in issue. Henning Hangyue Mansion was delivered in February this year, and after delivery, some landlords sold their units at prices lower than new homes. The price limit for finely decorated units in Hangyue Mansion is 34,000 RMB per square meter, but the current average price is only 33,000 RMB per square meter, and the average transaction price is as low as 26,000 RMB per square meter, significantly lower than new home prices. According to the report, an owner in Beiyuechao Mansion in Xiaoshan City recently sold his home at a loss of nearly 300,000 RMB. He explained that he was upgrading his home because the prices of both new and second-hand houses were falling. Many agents pointed out that in the current market environment, where supply exceeds demand, it is difficult for second-hand homes that have broken issue prices to stand out, and prices are still declining. Netizens expressed mixed opinions about this trend, noting that current housing prices have fallen to match new home prices, and questioned the possibility of a market recovery. Many netizens believe that buyers purchasing now might face further declines, leaving the future of the housing market uncertain.